One of the ongoing debates in the asset management industry is whether local fund managers are equipped to manage global funds successfully. Now, PSG Asset Management's track record speaks to the success that can be achieved, at least by selected fund managers. Most recently, the PSG Global Flexible Feeder Fund won the award in the Global Multi-Asset category over 5 years in the News 24 Fund Hub Industry Performance Awards. Joining me today to discuss our global process in more detail and our global funds is Deputy Chief Investment Officer Greg Hopkins. So Greg, to kick us off, can you explain PSG's process and how that aids us in delivering these kinds of results for our clients?
Yeah, so there's probably two parts to that. One is just maybe a little bit of context about the PSG global process, and then we'll talk a little bit about the track record and how it served our clients. We've been investing directly in global markets. This is particularly equity markets since 2008 as a team. We've got a very long track record in investing in global markets. We have one process, which is actually a global process, one team looking after that process. So South Africa would be included in that global process, but it's predominantly we see ourselves as having as this broader global process. And we've got a nice deep team. We've got 19 investment professionals in the team. The average tenure at PSG Asset Management is around 8 years. But if you look at the more senior cohort, the more experienced managers, that's closer to 12 years. And why that's important in global is over the last 8 years, we've estimated that we've actually looked at over 190 companies, global companies, in a large amount of detail. And all that muscle memory is now sitting with our team. So we think that this process compounds over time as we get more and more experienced and we look at more ideas. But having that good retention has actually set us up very well for investing globally. And the track record has been a testament to that in terms of being in the top quartile over relevant periods in our global flexible fund.
So Greg, recently we've seen quite a bit of volatility in the markets. However, even from the start of last year, we've seen something of a rotation in markets starting to take shape. So what are the implications of that for investors?
So this is a consistent theme that we've been talking about over the last couple of years, about, and particularly if you go back 2 or 3 years ago, we became quite concerned about what we would call the concentration in the US equity markets. Very, very crowded. Everyone was speaking about the US. Everyone is investing in the US. The US weight in the United States weight in the global benchmark is got up to about 70%. And what we suggested back then is that there was quite high risks in terms of actually investing in the US market at that stage. And we were seeing better opportunities elsewhere. This rotation out of the US into other markets has actually been quite prevalent, particularly over the last year, where we started seeing markets outside the US actually outperforming the US for the first time in probably about 15 years. We think this rotation is very much alive, and we think it's a multi-year thesis that could play out over many years. And we often get asked the question by investors in terms of the key problem that they're trying to solve is where the best opportunities are globally and how to avoid the risks when markets are very, very high. And we think this theme around rotation, moving away from high price markets where we do see a lot of risk into lower price markets, lower expectation markets where there's very good above average quality and below average price type opportunities. We think that is that will serve the investors very well in terms of looking in that space.
So, you touch on a current problem that we are seeing in the markets. Despite some volatility, markets are still quite close to highs. And for investors that are investing now, they face a dual challenge. On the one side, they have to consider how to protect their portfolios as they stand now, but they also have to position for growth, capital growth over the next 3 to 5 years. So can you give us some ideas about how investors should be thinking about this challenge?
Yeah, we do think that investors need to bring a different mindset to solving that particular problem for the next 5 years. And the portfolios that have actually served investors over the last 5 or 10 years in terms of being very US heavy and very quality heavy and very tech heavy, we think brings quite a lot of risk just given how high the prices are and how consensual a view it is. But if you look across the pond away from the US and you look into markets like emerging markets, you look into some of the developed markets like the UK and Europe, where expectations are a lot lower, there's actually very good opportunities there. And particularly from a South African context, where over the last 10 years, South African general asset returns have been, somewhat muted. When you're looking abroad now, there are still good opportunities, and they and we would expect in certain areas, very good returns.
So, what are the opportunities that you are currently seeing in markets?
So we did talk about just earlier, geographically. So ideas, opportunities in the UK and in Europe and in emerging markets. We've got a significant exposure to emerging markets in our global funds. And we can talk about one or two opportunities if you're interested in a couple of minutes. From a sector perspective, we have got a reasonably good weight in what we call real assets. So energy, resources, real estate. These do act as good geopolitical hedges, which we're seeing at the moment. We're seeing when the oil price is rising. These sectors can actually play a dual role in the portfolios, particularly protecting against rises in future inflation. And then within sectors, we've also got a nice diversified portfolio in terms of consumer staples and healthcare. Healthcare is an area we've been adding to over the last year. Healthcare names sold off quite aggressively in March, April last year when the Trump administration had some views in that sector which drove the prices down. And so when you look at that balanced portfolio, a lot of diversification, but good opportunities for the future.
And in more detail, can you name some of those opportunities for us or give us an idea?
Yeah, so energy would be a good starting point. The nice thing about energy, when we think about it, it plays quite a few different roles in the portfolio. One is a fundamental role on a bottom-up basis. We've seen a big underinvestment in energy over the last decade at a time when the world needs more energy, particularly in fossil fuels. So your supply-demand balance, supply has been actually falling. Demand continues to rise. Very good for this type of sector in terms of future prices. But the starting yields in the sector are just been really, really good in terms of dividend yield or payout yield, double-digit yields in certain parts of the portfolio. And in an environment where we think that asset markets, general asset markets, particularly global, could see lower returns or give you lower returns than we've seen over the last 10 years, starting with these high dividend yields and these high payout yields, is a very good opportunity. Another area would be looking at is in China. We talked about emerging markets. A company like Anta, it's called Anta, which is the largest sports sort of footwear and athleisure company in China. You can think of Adidas and Nike. These are competitors. Anta's been running circles around Adidas and Nike in China. It's got a very, very good long-term track record, grown its earnings and revenues at over 20% CAGR over the last 10 years. Very good management team. The founder is still involved in the company. He owns more than 50% of the company with more than $10 billion worth of exposure in the company. And a very attractive valuation. It's trading at around 12, 13 times earnings, which is half the average multiple in the MSCI world in a company which we think is above average quality. The opportunity there has been presented. We often get asked why the opportunity, why would we be getting the opportunity now? Consumer confidence in China is very, very low at the moment. They've had quite a tough macro environment in terms of a housing bust. We've seen in the past these take time to work their way through the system, but we think the prospects for the business look very, very good, and we would expect double-digit earnings growth in the foreseeable future from that type of company.
So Greg, there's opportunities and you're still finding good spots to invest in despite what we're seeing in markets at the moment, but there are risks out there.
Yes.
And what do you think are the risks that investors should bear in mind, and what should they be thinking about when positioning portfolios? Yeah,
we do get a sense that there's a reasonable amount of complacency in global markets, but particularly in the US. We're seeing some red flags that would make us be warrant a little bit more cautious, a little bit more caution. Cash levels. So there's a Bank of America fund manager survey in February suggested that cash levels in these global funds, the participants in the survey, so that's the amount of cash they have as a percentage of their NAV, are at record low levels. And that means that, investors are very bullish about the future prospects. We're seeing IPOs coming into the market. We're seeing insiders in the US stock market selling, so CEOs selling shares. We're seeing record amounts of leverage, in the retail investor channel. All of these signs suggesting to us that we are getting indications of a more mature bull market. And as Warren Buffett mentions, and he's very good at this, the less cautious or the less prudence that fund managers are conducting their affairs, the more prudent that we should be conducting our affairs. And as a result, we've allowed the cash balances in our global flexible fund to be rising over the last year. We're sitting at over 20% cash from around single digits a year ago. We have also got some derivative protection on. So we think this is not the time to be brave. One needs to be a bit more cautious, but you balance that with some of the opportunities that we've talked about as well. In the areas that we talked about, and we do think that you could actually blend the two. Good opportunities on a bottom-up basis where expectations are very low and we would expect good returns, but overall, just generally a little bit more cautious.
Greg, thank you so much for joining me today and talking about our global funds and global process.
Thank you. It's been my pleasure.